My name is V. Prasad. My subject is accounting for managers. My topic is generally expected accounting principle. Accounting. Accounting is a process of regarding the classifying and summarizing financial transactions. It provides a clear picture of the financial health of your organization and its performance, which can be served as a continually resource management and strategic growth. Principles of generally expected accounting. Generally, accounting expected of principle is the set of accounting rules and set forth by the financial accounting and standard boards of that US companies are expected to follow in putting together the financial statements. The goals of GAP is to ensure that a company's financial statements complete, consist, and comparable. Principles of regularity, principles of consistency, principles of sincerity, principles of performance and methods, principles of non-composition, principles of prudence, principles of continuity, principles of periodicity, uh, period of materiality, principles of utmost good and faith. The principles of regularity. The principles of regularity dictates that accounts must abide by all established rules and regulations. It is the principles that establish that mandate that all other principles and regulations set forth gap must be always followed. The principles of consistency. The principles of consistency dictates the accountants must apply consistent standards throughout the financial reporting process. The principles of sincerity. The principles of sincerity dictates the accountants must be strive to provide a complete and accurate depiction of companies and financial situations. The principles of performance and methods. The principles of performance of methods dictates that the accountants must aim to the consistent set of procedures throughout the financial reporting process. The principles of non-compensation. The principles of non-compensation dictates that all the financial information must be disclosed regardless of whether it is positive or negative for the company in question. The principles of prudence. The principles of prudence dictates that accountants must present all financial information as is, avoid presenting any data that is based on speculation. The principles of continuity. The principles of continuity dictates the accountants must value asset based on the assumption that the company will continue its normal operation. The principles of priority. The principles of priority dictates that financial reports must be released based on the predetermined schedule as a very such as a very physical quarter of physical year. The principles of materiality. The principles of materiality dictates the accountants must strive for a full disclosure of a company's monetary situations. The principles of utmost good faith. The principles of utmost good faith dictates that is it should be assumed that all parties involved a transaction are acting honesty. What is the five basis accounting principles? Revenue recognition principle, cost principle, matching principle, objectivity principle, full disclosure principle. First one, what is the meaning of gap in accounting? Generally accepted accounting principles are gap are standard that encompass the details, complexities, and the legalities of business and corporate accounting. The Financial Accounting Standard Boards uses GAAP as the foundation for its comprehensive set of approved accounting methods and practices. Thank you for the giving opportunity.